now acting as a resource person for the same MMTC Mysore University. So thanks for the opportunity. So today's topic is understanding startup valuation and guide to assessing early stage companies. As you all know, startup is one of the emerging trend now. The government initially providing and even now providing financial assistance to the young entrepreneurs to promote entrepreneurship in India. But recently, our government giving scope for this startup. Startup normally young startup companies simply referred as a young business enterprise funded by entrepreneurs to develop and bring innovative products, services, or solutions to the market. You all know that. So why we should know the valuation methods about this startup? So initially, as I told, government was funding for young entrepreneurs. Recently, angel investors, crowdfunding has become one of the most popular mode of funding for these startup companies. So they will be eagerly interested to know about the value of each startup where they have invested their funds. So valuation method in that manner becomes an important thing for this startup. So here, a young business aiming to develop. So in a few slides, we shall discuss what is a startup and how we can categorize these startups into different groups. So a young business aiming to develop and bring innovative products. A startup is a young business aiming to develop and bring innovative products, services, or solutions to the market. So it focuses on rapid growth and scalability, operates in dynamic sectors like technology, biotechnology, or e-commerce. And these startup companies seek funding from venture capitalists, angel investors, as I told, or crowd funding. So key concepts of startup companies: innovation, novel products or services, totally new products is the main focus of these startup companies. Growth, rapid scalability, risk taking, they embrace uncertainty, and entrepreneurship driven by entrepreneurial spirit. Investment is required, which is essential for growth, and limited resources and lean operations, one of the characteristics of this startup. Risk is very high, and adaptability is one of the characteristic. Innovation centric implications drives economic growth and job creation, disturbs traditional markets. So definitely, if a new company came into existence, that disturbs traditional markets, and high investor return potential. That is again a possibility for this. So advantages: forefront of innovation and technological advancements. So by encouraging startup companies, we can encourage innovation and technological advancements. Definitely, startup companies creates job opportunities and drives economic growth, identifies untapped market opportunities. So normally startup companies focusing the untapped, untouched market opportunities in the target market, and fosters entrepreneurial spirit, potential for high returns. So drawbacks: high failure rate and financial uncertainty. So we can quote many Baiju, you take for example, failure rates will be more and financial uncertainty will be there. And resource constraints, market competition will be there. So for new undertaking, new companies, competition will be there. And the resource constraints is one of the drawback. Stress and pressure on founders and team. So definitely when you begin with a new task, stress will be there, pressure will be there. So we can simply say a startup like a box. It's a special box. The box has a value. So its value increases as you put more things in the box. So the valuation of startup companies is determined by cohort of positive as well as negative factors. So initial value, especially in case of this startup, will be 0. A startup begins as an empty box. Value begins with 0, representing the initial idea, concept, or product. The box has intrinsic value due to its potential. So adding value to the box increases value of that startup. So innovation is first thing. Each innovative product or service or feature added to the startup is like placing a valuable item into the box. So these innovation make the box more valuable. And second thing, market validation. So customer acceptance and validation are crucial. So sometimes a product that we launch to the market may be very good, but customer acceptance is very much required. If customer rejected our product, definitely we can't survive in the market. So second value added to that empty box is market validation, that is customer acceptance. When customers start using and appreciating the product or services, it's like filling the box with validation certificates, increasing its value. And revenue generation. Revenue is like gold coins being placed in the box. So startup valuation begins with empty box, and we go on adding value to that box. Begins with innovative idea, product, service, or features. Second, market acceptance. Third, revenue generation. That now putting gold coins to that particular empty box. And scaling operations, that means expanding business operations, and market reach is like adding more compartments to that particular box. So each filled with growth opportunities and additional values. Building a strong team. So a talented and dedicated team is like placing the rare and valuable items in the box. So each team member contributes unique skills and efforts, enhancing the overall value. So positive factors influencing startup valuation. We can see here unique value proposition. First thing, the positive factor that influencing this startup valuation is unique value proposition. That means offering unique and valuable solutions that stand out in the market at significant value. So identifying the problems of the customers, needs of the customers, and giving unique solution to those problems. So definitely is one of the positive factor influencing startup valuation. It's like placing a rare gem in the box that attracts attention and admiration. So when a totally innovative product which is giving solution to our problems is offered in the market, definitely we all are attracted with that particular product. So unique value proposition is one of the unique, positive factor that is adding value. And market size and growth. Second thing, operating in large and rapidly growing market increases potential value. So imagine the box expanding in size to accommodate more valuable items. So that definitely is a positive factor influencing the startup valuation. And third, strong intellectual property. Strong intellectual property, owning patents or proprietary technology is like securing treasures within the box that others cannot easily replicate or steal. So if we own patent rights or proprietary technology, so we can secure our treasures and others cannot replicate or steal. And fourth one, positive financial metrics. So demonstrating strong financial performance and growth potential is like stacking the box with financial statements showing profitability and growth. And fifth one is brand recognition. Building a strong and recognizable brand is like placing a shining label on the box that makes it highly sought after and reputable. So these are positive factors influencing startup valuation. So negative factors, market competition. That is also influencing startup valuation. Intense competition can limit growth potential and diminish value. It's like other boxes in the market vying for the same space and attention, making it harder for your box to stand out. And second thing, operational challenges. Significant operational hurdles, uh, hurdles or inefficiencies can reduce the box's value. So they are like adding weights to the box, making it harder to lift and carry forward. Financial instability is another negative factor influencing startup valuation. Cash flow issues or financial instability can detract from value. It's akin to having holes in the box through which valuable items might slip out. And fourth one is regulatory risk, navigating regulatory challenges that could impact the business is like having locks on the box that are hard to open, restricting access to its contents, and lack of differentiation. So when new product is offered in the market, we should be able to differentiate our product with other products. So struggling to differentiate from competitors can make the box less attractive. If we can't differentiate our product, so that is again one of the negative factor influencing the startup valuation. It's like having a plain, undistinguished box among many others, failing to catch the eye of investors or customers. So, why valuation of startup is very much necessary here. So, evaluating startups accurately poses significant challenges, particularly for venture investors who rely on these valuations to estimate potential returns. So, when we are investing some funds on some tasks or startup companies, definitely we, being investors, expect some returns, more returns normally. So that traditional valuation methods often fall short for early stage businesses because lack of sustainable accounting information. So newly startup companies lagging accounting information and forcing reliance on assumptions and educated guesses. So startups typically have limited revenues. Initial stage, the startups will be having limited revenues and short operational histories. So we do financial analysis. You take, for example, a 50 years old company or 100 years old company or 10 years old company will be having 10 years financial data with us to assess the performance of the companies. But here, they will be having short operational histories and dependence on private capital. Private capital complicating standard techniques for estimating cash flows, growth rates, and discount rates. Additionally, the high failure rate of young companies must be factored into any valuation model. So the current valuation of a startup is heavily influenced by market forces, including the balance of demand and the supply of capital, the recent successful exits, and the willingness of investors to pay a premium to enter deals. Today's market perception of future potential plays a crucial role in determining startups' value. That means today's market perception of future potential. So how much you perceive about future potentiality. So that is the basis in determination of startups value. So the complexity of valuating young companies often lead to analysts to seek seemingly easy solutions, which can result in significant valuation errors. So the primary determinants of a startup's value include market dynamics within its industry and sector, recent exits, investor sentiments, and the urgency of the entrepreneur's need for funding. So key factor influencing growth and valuation are the attractiveness of industry, capabilities of the startup team, and competitive advantage of the product or services offered. So you can see here, key factors influencing growth and valuation or attractiveness of the industry. To what extent the product offered, new product offered in the market is attractive, and capabilities of the startup team. Capabilities of the startup team and competitive advantage. That means how can you differentiate your product from the substitute products in the market? Competitive advantage of the product or services of. Understanding and accurately assessing these elements are essential for making informed investment decisions in the volatile and high-risk startup environment. So there are several methods in startup valuation. Most popular startup valuation methods are venture capital method, workers method, scorecard valuation method, risk factor summation method, cost to duplicate method, discounted cash flow method, valuation by stage method, comparable method, the book value method, potential value at exit, sum of the parts method. First, Chicago method. There are several methods. I'm highlighting here 12 methods, and I don't know to what extent we'll be able to cover these methods. So let's see. We shall at least cover some of the methods that are shown in this slide. So venture capital method. So this method was developed by, concept was developed by described by Professor Bill Salmon at Harvard Business School in the year 1987, venture capital method. So it is an assessment, venture capital method is an assessment for valuing startup and high growth businesses. High growth businesses. It is based on the company's projected earnings at a certain future date. So we do budget, like similarly, we project earnings at a certain future date. According to this venture capital method, we project earnings at a certain future date, taking into account the money multiples and associated rate of return the investor would like to earn on their investment, assuming they will exit the investment at a specified future date. So you take, for example, you have been investing some amount now, 2024, in the month of October. So after 5 years, what will be the return, projected earnings of that particular startup? On that basis, we assess the valuation here. So the venture capital method calculates exit valuation. So after 5 years, I'll be going to, exit from the industry or environment. What will be the projected return? So the exit valuation at a specified future date by applying observed multiples. These are the some observed multiples of comparable listed companies and comparable transactions to the target company's future earnings. So taking this exit value into account, it then determines the price at which investor can invest today in order to achieve their target money multiple and associated internal rate of return. So here, the important 2 steps. So when we read that paragraph, we will not be able to understand. But here, venture capital method, what we do, we use 2 methods. So first step, 2 steps. First step, calculate the terminal value of the business in the harvest year. Terminal value of the business in the harvest year. And step 2, track backward with the expected return on investment and investment amount to calculate pre-money valuation. So what is the terminal valuation? Calculating the terminal value. So we need to calculate these figures. Projected revenue in the harvest year, projected profit margin in the harvest year, industry price earning ratio. So these things we need to calculate. The industry average for the price earning ratio and projected profit margins are to be found through industry research. So this can be done through industry research. Industry average for the PE ratio can be done. So this thing, the industry average for the PE ratio, projected profit margins through industry research. So perform calculations here, terminal value, projected revenue multiplied with projected margin multiplied with PE ratio. So earnings multiplied with PE ratio is the projected revenue. So calculating pre-money valuation. So here, pre-money valuation, step 2, find the following figures. Required return on investment, first thing, investment amount. So first we need to calculate these things. Required return on investment, how much you are going to expect, how much return on investment you are expecting, and how much you want to investment amount. So through these two things, we need to calculate the pre-money valuation. Just see here, terminal value. The step 1, we have calculated terminal value divided by return on investment minus investment amount. So pre-money valuation we'll be able to get. So next is second method, Burkus method. Second method, Burkus method, second popular method. Burkus method again is invented by Dave Burkus. It is name of the expert in that field. Burkus calculates company value before their first revenue. It calculates company value before their first revenue. In 1990s, Dave Burkus first developed this method. He's a well-known angel investor. So hope all of you know who is an angel investor, a wealthy investor and venture capitalist in US, United States of America. So Burkus method of valuation is an early stage valuation method that was explicitly created to find a starting point without relying upon the founder's financial forecast. Without relying upon the founder's financial forecast, the Burkus method studies 5 crucial areas. So according to this method, we consider 5 crucial areas of startup and indicates a value ranging from $0 to $5 lakh for each area. $5 lakh for each area. So it assesses a startup value based on 5 key factors. As I told, 5 different factors are taken into account here for valuation of startup, each representing different elements of the business. These factors are scored and assigned a specific monetary value, which are then summed to provide an overall valuation. So what are those key factors? Let us see. So the critical criteria under Burkus method to understand. So sound idea. First thing, sound idea. Second key factor, prototype. Third one, management relation. Fourth one, strategic relationship. And fifth one, product rollout. So according to Burkus, 5 key factors are identified here. So first thing is sound idea. Second one is prototype, management valuation, strategic relationship, and fifth one is product rollout. Here, what is that? Sound idea. For each criteria, Burkus allocates $5 lakh, value up to $5 lakh. So idea. So when you are going to begin or start a new company, idea, to what extent your idea is sound. This factor considers the inherent value of the startup's core idea or concept. So it evaluates the uniqueness. So it will be considered as a sound based on its uniqueness, feasibility, potential impact of the idea in the market. Okay, second criteria is a prototype. Prototype, again, same amount is allocated for this $5 lakh. So having a working prototype reduces technology risk. So sometimes we'll be having very good ideas, but we are unable to convert those ideas into a product. So to reduce the technology risk associated with the conversion of that idea into a product, here $5 lakh is allocated for that, having a working prototype. So we need to develop a prototype, working prototype. So this factor assesses whether the startup has developed a prototype or proof of concept that demonstrates the idea's viability. So whether we can produce the product according to our idea and market in the market to the customers. So to test that, we need to develop working prototype here in second key factor. So third one is quality management team. So here, so this is again considered as one of the key factor for a startup. to reduce execution risk. Sometimes we will be having very good idea and we have developed very good prototype, but we fail to execute. So to minimize that execution risk, another key factor is identified, that is quality management team. Again, same $5 lakh is allocated, value up to $5 lakh. So quality and experience of startups management team are critical for execution. So this factor evaluates the team's ability. Sometimes the product may fail in the market because of team's inability. So team's ability is tested in third criteria, ability to bring the product to market or scale the business effectively. So fourth one is fourth criteria is strategic relationship, reducing market risk. Another important thing is strategic relationship. So you take, for example, first criteria is successfully done, second one is also successfully done, third is also done. But if you fail to have strategic relationship or partnerships, the product may fail in the market. So here again, same amount is allocated up to $5 lakh. Strategic partnership and relationship can significantly reduce market risk. So before entering into the market, we need to have a strategic relationship or partnership. So this factor assesses a startup's connection with potential customers. We need to identify potential customers, partners, and industry players. So here in fourth key factor that is done, and product rollout or sales here. Launching product, reducing production risk. So here, same amount is allocated up to $5 lakh. Early sales or a successful product rollout demonstrate market demand and production capability. So this factor evaluates the startup's initial market traction and sales performance. So in workers method, the 5 different areas are identified, and for each area $5 lakh is allocated, and before entering into the market, the research is carried out to understand whether the company can easily move into and launch its product in the targeted market. Third method is the scorecard valuation method. The scorecard valuation method is widely used approach. Again, this is very popularly adopted for evaluating early stage startups, widely used. Particularly, this method is useful for angel investors. Angel investors. It involves comparing the target startup with a typical startup in the same region and industry. So the newly started startup is compared with typical startup. That means a similar startup in the same region or industry. Here is a breakdown of how the scorecard valuation method works. So step-by-step process, determine the average pre-money valuation, identify key factors, score the startup, calculate the weighted score, and adjust the benchmark valuation. So here there are totally 5 different stages or steps are identified in scorecard valuation method. So how each step is carried out, let's see. So first one, determine the average pre-money valuation. So identify the average pre-money valuation of startups in the region or industry. So you take, for example, you are going to start a new company in Mysore region or in the Dharwad region or in some region. How much funds I want, pre-money valuation in that particular region or industry, in that particular industry. So this serves as a benchmark for comparison. So this will help us to know this serves as a benchmark for comparison. So step 2, identify the key factors. Identify the key factors. The method evaluates startup based on several key factors, each assigned a weight based on its importance. So common factors are strength of the team. So what is the strength that is going to begin with a new task or assignment? So for that, weight assigned is 30%. Strength of the team, here 30% weightage is given. It is based on experience, skills of the founding team. Second, market size and startup's product or service. Next, product technology. For this purpose, 15% weightage is given. Considers the innovation, competitive advantage of the product or technology. That means to what extent you can differentiate your product, substitutes available. For that purpose, here 15% weightage is given. And the fourth, competitive environment. So looks at the level of this startup's ability to differentiate itself. To what extent environment is competitive. 10% weightage is given for this. And marketing sales channels. For that purpose, again, 10%. So key factors here, strength of the team, 30%, size of the opportunity, 25%, product technology, 15%, competitive environment, 10%, and marketing sales channels, 10%, need for additional investment, analyzes startups funding needs and the plan for future capital raising. For that is also 10% weightage is given. Okay. And third, score the startup. So here, in third step, the target startup is rated on each of the key factors based on these weights relative to the benchmark startup. Scores are typically given on a scale 0 to 1. Scores are given on a scale 0 to 1, where 1 means the startup meets or exceeds expectations for that factor. So if multiply the scores for each factor by its assigned weight, whatever strength of the team, 30%, like this weights are given. The total score is multiplied with the weights and sum the results to get the overall score. So this is the scorecard method. Adjust the benchmark valuation, adjust the average pre-money valuation based on the overall score. If the startup scores higher than the benchmark, its valuation is adjusted upwards. And if scores are lower, the valuation is adjusted to down. Fifth step. So next is risk factor summation method. A risk factor summation method here. The risk factor summation method utilizes a base value of a comparable startup for the company's valuation. Comparable startup for the company. Company valuation. So this base value is adjusted to 12 common risk factors. So this indicates that if a startup is compared to other startups in terms of evaluating, that will have a higher or lower risk. The following steps will make it more straightforward on how risk factor summation method works. So begin with an average company's valuation formulated on a similar companies in your area and region. Draw some time for this step. Fetching relevant data of a comparable company will need some time. So next, analyze different risk factors for your startup from a very low to a very high range. Risk factors, and lower risk increases company valuation while higher risk decreases the valuation. And to enhance company's valuation, you will have to work on the risk and map out ways to reduce the risk. So risk factor summation method. So find the average industry. Here, step 1, find the average industry pre-money valuation. So this step is similar to the first step of this scorecard valuation method. In this step, we need to attain the average industry pre-money valuation of the target. Target startup. And step 2, consider 12 risk factors. 12 risk factors. What are those? Risk of management, stage of the business, political risk, supply chain or manufacturing risk, sales and marketing risk, capital raising risk, competition risk, risk of technology, risk of litigation, international risk, risk of reputation, exit value risk. So here, 12 different types of risks are identified. You can see here the risk factor in this chart. So stage of development, early stage versus established. Risk of stage of development here. The strength of the management team, experience, industry knowledge, reputation, size of the opportunity, addressable market and growth prospects, product technology, technology sophistication, level of innovation, IP protection, competitive environment, marketing and sales, technology risk, like complexity of the technology and level of development required, manufacturing risk, legislative and regulatory risk, financial risk. So for what we identify 12 different types of risk. For each one, some examples are given here. Financial risk, for example, debt level, how much debt we can have, cash runway, a capital intensity of the business model, litigation risk, for example, potential for lawsuits or intellectual property disputes, international risk, exposure to foreign markets, currency fluctuations, etc. So step 3, castigate all the risk factors. So the third one here is to assign ratings to all the above mentioned factors of risk. So 12 risks we have identified. Once the assessment is done, perform an adjustment to the average pre-money valuation of the startup. Rather than assigning percentage, weights, and multiples, we allow the following ratings to each risk factor. Ratings to each risk factor can be evaluated as follows. So extremely positive mitigation, add $5 lakh. Positive mitigation, 2,50,000. Neutral, add or minus nothing. Negative mitigation here. Negative mitigation, $2,50,000. Extremely negative mitigation, minus 5 lakh. Like this. So add the pre-money valuation. In this last step, you have to add average industry pre-money valuation with adjustments. Okay. So next is the cost to duplicate method. Cost to duplicate method. Here, the cost to duplicate approach to value startups focuses on the cost and expenses that took to create the startup. It measures how much it would cost to recreate the company from scratch. So in the accounting concept, we have studied the replacement cost of an asset. If you want to replace the same asset with new one, what would be the cost of replacement cost to replace that particular asset? The same way here, the cost to duplicate approach, value startup focuses on the cost and expenses that took to create the startup. Same startup, if you want to create, how much we need to invest in. It measures how much it would cost to recreate the company from scratch. The idea behind it is that potential investor would not allow a higher valuation than the aggregate sum of the expenses that took the company to get to that point. So this is quite straightforward to calculate for physical companies, and for online-based SaaS type businesses, the final figure could be worked out as the overall cost of development forward into making the software. So there are a couple of issues with this approach. First, it fails to take into account future sales of the company. Last, and most importantly, it ignores intangible assets. which arguably constitute the real lever into the potential success of a startup. So by overlooking intangible assets such as industry reputation, B2B partnership, brand recognition, human capital, and intellectual property, the cost to duplicate approach may feel quite, what do you say, replicable, acceptable, unreliable. Okay. So next thing is calculating the value of startup using cost to duplicate method involves summing up all the tangible costs. Yeah, as we discussed, seen in the last slide here, it ignores intangible assets such as industry reputation, B2B partnership, brand recognition, human capital, and intellectual property rights. So ignoring that, calculating the value of startup using cost to duplicate method involves summing up all the tangible costs that have uh, been invested in the company. So this method focuses on actual expenditures made to create and develop the startup. But the human capital invested, then intellectual capabilities used in developing or strengthening that startup are totally ignored here. Here, step-by-step guide to performing this calculation is, so first one, development costs are taken. Second, physical assets are taken, operational expenses are taken, costs related to marketing are taken, then legal and formation costs are taken, loan and interest payments are taken. Total different, 6 different types of costs are taken to calculate value of startups under cost to duplicate method. So next is, sixth one is discounted cash flow method. So discounted cash flow method determines the value of a business by estimating its future cash flows, discounting them at a certain discount rate. Even now in some accounting areas, we do this, and even finance also we do the discounted cash flow method we follow. Here in this method, what we do, value of a business is estimated using future cash flows, as discounted them at a certain discount rate to obtain their present value. The sum of these discounted cash flows will be resulting valuation for the startup. Since this method relies heavily on assumptions that require some historical data to be performed, it is not the most widely employed to value startups. So majority of you are familiar with this discounted cash flow method in security analysis and portfolio, in financial management, even in some of the accounting areas, we do this method, but it is not widely employed to value startups because this method relies heavily on assumptions that require some historical data. So on the basis of historical data, we can make assumptions, but here in case of startups, we are lacking this historical data. So it is not frequently used. So the discounted cash flow method is a widely used approach to evaluate companies. It involves estimating the future cash flows that company will generate and then discounting these cash flows back to their present value using an appropriate discount rate. So you can see here in this chart, cash flows discounted, discount each year, then the terminal year value of a business. So steps in discounted cash flow method, create a financial model here. First thing, we need to create a financial model, then calculate the future cash flow, determine the terminal value, and determine intrinsic value, find net present value of explicit period and terminal value, calculate the weighted discount rate with that. So reverse would. Here, third, fourth, fifth, sixth, like this we should go here. Discounted cash flow method. Next is valuation by stage method. So I have to give some minutes for discussion. There are totally 12 minutes. I think we are short of time to discuss all the methods. So we have covered 6 methods. Let's have a discussion on this topic. I hold other 6 models. So if you have any queries, you can ask on this. It's a technical matter.
Madam, which method is used very popularly by the angel investors?
Workers method is one of the method which is popularly used.
Okay.
Workers method is the power.
Ma'am, you can, if you can just display the list at least, madam, we'll write down the other methods.
You want that list?
Yeah.
Yeah.
You can just note down. Yes, ma'am.
Venture capital, workers method, scorecard. Even venture capital method is also widely used method. So these are the 2 popular methods. Venture capital and workers method are the 2 popular methods used.